Happy Friday, Eric Bible with the Bible team at Neo Home Loans. More good news this week, and it really is starting to appear that we've entered a new range for mortgage rates. Truly is appearing as if we've turned a corner. I know I've spoke of this over the last few weeks with positive economic news, and it's looking like the narrative is now taking legs, and Wall Street is ultimately seeing and believing this thought as well. So we'll start with where the 30-year fix sits this morning and ultimately what drove rates to do what they did this week, what we expect going forward, and also we'll close with some components around agent commission, as I know that is an incredibly hot topic right now. So first and foremost, what drove or where are rates today as opposed to where they were last week? This morning, I'm happy to report the 30-year fix is starting at 7.39%, down from last week's high or close, I should say, of 7.49. So again, small incremental wins, but wins nonetheless. So what drove the move down this week was really yet again data-driven, information-driven, and ultimately what we expect and can foreshadow going forward from here. So this week, we received the all-important inflation data through the Consumer Price Index for the month of October. That was released on Tuesday. Expectations walking into that was yet again moderation in inflation, but the beat was in our favor, and it came in the form of the headline number dropping to a whopping 3.2% year over year, which is a huge decline. We saw 0% move in inflation on a month over month basis. And more importantly, on the core reading, we saw a 0.2 increase on a month over month basis, which dropped core rate of inflation to 4%. And keep in mind why core is so important is one, it strips out food and energy, which ultimately Fed rate hikes can't impact. And that's really where the Fed's 2% target comes from. So a solid pullback in inflation ignited a very meaningful rally, very similar to what we saw with the miss in jobs. It really confirmed two things. One, that inflation is coming down. And two, that the Fed rate hikes we've seen through this cycle have ultimately started to work their way through the system. And now Fed Watch Tool, which is really what Wall Street is betting in regards to future rate hikes. One, it's a 99+% guarantee. We will not see another hike this year. So next meeting, December 13th, the markets are effectively betting and almost guaranteeing that the Fed will not hike again. And it's appearing we will start to see cuts as early as June based on what Fed Watch Tool is advocating. And why this is so important and why this means so much to not only us, our economy, what this means for our buyers and sellers, as the market ultimately confirms that the Fed is done with this hike cycle, we will start to see mortgage rates pull back, much like we've seen over the last few weeks. This rally was again continued into Thursday through Wednesday retail sales. Yet again, another miss, 0.1% decline. It was a negative number. First time really seeing the consumer pull back spending since March of 2020. And there we saw yet again another rally on that front. And again, it's just indicative of the economy is slowing, going back to what I said earlier, that the Fed is likely not going to hike next month and realistically hike in this cycle going forward. Thursday, then we received jobless claims, 8th consecutive week where we saw incremental increases in first-time filings of unemployment, which much like the jobs report we received at the beginning of this month, it is continuing to edify and confirm that there is weakening in the labor market. Two important things that the Fed has continued to advocate and speak around: inflation coming in line, which we saw this week, and two, employment softening, which again is a good future indicator that inflation ultimately is behind us. So all this data together ultimately confirmed that we appear to be in a new cycle when it relates to where mortgage rates go from here. So really what we're expecting to see is improvement, further improvement, I should say, with mortgage rates really through the end of the year. So as always, we'll continue to deliver this message on Friday to ensure that you're constantly informed. Also, last week, we asked you to complete our national housing survey offered through one of our partners. I'm happy to share the results. And yet again, despite the fact that interest rates remain elevated, albeit, yes, we've seen them pull back, housing continues to remain incredibly strong, which again reconfirms the narrative that we must deliver to our clients. Now is the time to take action. And if we truly are going to experience interest rates decline, much similar to what we saw at the close of 2022, the clients that take action now are ultimately the winners. We know inventory is still incredibly low. We know that inventory is not going to be solved overnight. Interest rates can be as low as they want, but if there's nothing there to buy, demand only increases, and in turn, the price of the home does as well. So again, the message we need to continue to deliver to our clients is now is the time to take action. Ultimately there to agent commission, we know that this is an incredibly hot topic amongst our community, the broader real estate and finance community, but also from our clients. Really, for the first time in my career, I've heard buyers and sellers approach us as the lending community of what does this mean? Meaning, do I need to pay a buyer or is it going to fall under the previous realm? And it all comes down to determining value. It's an investment on behalf of the buyer to seek advice through a professional, much like yourselves as realtors. So here at NEO, we're really striving and working diligently in putting together a comprehensive response of the importance of the investment on behalf of the buyer, of paying the commission if in fact it does go in this direction. So definitely stay tuned, more to come on that. I'll close with this. We're approaching the Thanksgiving holiday, and typically this time of year, it's indicative of a slowdown. We like to step back, spend the time with our family. And I'm not saying you can't. I know I sure will. But the opportunity that is now being presented with the fact that rates are starting to pull back, clients are seeking engagement, becoming more active than we've seen over the last few months. The actions we take here now will ensure our future success. So yes, enjoy the holidays, but do not take your foot off the gas now. It is more important now than it has been in our recent history to take advantage of the opportunity presented to us. Make it a fantastic Friday and an even greater weekend. And as always, if there's anything we can do to support you in delivering this message, we're here to help. Talk to you soon.